Hello, welcome back. Lau Chin An here again. Today we're going to do a chit chat on public ruling, and I would like to do a quick discussion on one of the public ruling that was recently released in December 2022. Now we all know that public ruling is not law per se, but is actually the Director General's interpretation of the law. As what you can see over here, this is what it says. So if you are in the positions that you want to challenge the public ruling, you can, but we usually won't do that, because when you agree with what the public ruling says, then generally the government will also agree with what you're doing. So one of the public ruling that was released towards the end of 2022 is this public ruling for property developer, which is ruling number 9 that was released right before Christmas. So you can see the government released quite a number of public ruling before Christmas and after Christmas. They are very hardworking. Okay, now I'm going to bring you through today in a very short part on the first part of this public ruling. This is actually a ruling that replaced an older ruling that was issued in 2009 and then replaced in 2016. Okay, so I'm now in the public ruling itself. Now you can see the public ruling gives you a long list of content. This is one of the very long public ruling that comes with 51 pages long. And what is it that we need to be aware about property development? Now you know that a property developer, they develop projects, and then they take time to actually recognize the income because of the length of the project. So you can have a project that could easily take 2 to 3 years. So the questions that we always have is, how does the Inland Revenue tax the income arising from a project, especially when the project is ongoing? So the argument is, do we wait until the whole entire project is completed, then only we recognize the actual profit arising from the project, or we actually recognize the income on an estimation basis? Now the answer is, the Inland Revenue actually recognize the income on an estimation basis. So today I will bring you through a little bit about what the public ruling says over here. Now I'm just going to jump into a few parts directly. Since it's a short sharing, I just want to go straight to the main point. Now if you go under point 4.1, they actually give you a short discussions to give you a guidance about how do you determine the commencement date of a property development business. You can read the example yourself. And we will jump straight to item number 6. Now the issues that we see here in item number 6, if you can see at the title, it's already saying the recognition of income prior to the completion of a project. So before a project is completed, how do we recognize the income of the project so that the government will tax you? And what are the various issues that would arise from this particular approach? So you can see over here, it mentioned very clearly that the income from the property development business will be recognized as the activity progresses, and the way they do the recognition is based on this thing called the stage of completion. So the question is, how do you know how many percent that this particular project has already completed? So basically in 6.3, they tells us over here, the stage of completion of a property development project is based on the percentage of completion method. So the question is, how do we derive the percentage of completion method? Now in the public ruling itself, they give us 2 examples. They say you can use the progress payment method, you can use the cost incurred method. So for simplicity, we will just look at the idea of progress payment method. Now take for example, if let's say you have a particular project that the value of this project will comes to 30 million. Now the whole idea or the whole logic is this: if let's say during this particular period your progress payment is able to reach, let's say, 15 million, now then basically you can say you are achieving a 50% completion for this particular project. So the logic is, why are you getting 15 million out of 30 million? Well, that's because you have reached a 50% completion. So this is the method that we use over here called the progress payment method. Now you can also calculate the percentage of completion according to the cost method. So there are actually two different methods that you could use over here. Okay, so I will take you through in the example that public ruling has given us. Now let's just jump into example number 5. Now what it says over here is there is this Syarikat E that they closes their account to 31st December and they commence a housing project. It's just one phase. That means it's one project on itself. You could have multiple phases which will then be basically categorized as different projects. Alright. Now, so in these particular projects, they say that they're going to start in 2016 and they will actually expect to complete in 2019. You can see over here. Now, they estimated that in this project, they will have a sales value of 24 million. That's what they're going to sell. And they also estimated the cost of the project will actually be 16 million. So guys, how much is the estimated profit from this particular project? You just take 24, you minus 16, you're going to get 8 million. Okay. Now, but the issues that we usually going to have is how would the government tax you? Because you can't wait until 2019. Then only you tell the government, okay, my profit is 8 million and I'm going to pay the tax now. So basically what you have to do is you need to do an estimate of the amount of profits that you're having in each of the respective year of assessment. So how do we do that? Now, one of the method that we're going to use over here is we will estimate using the progress payment method to derive the percentage of completion. So the public ruling gave us a table over here. As you can see in this table, the progress payment received and receivable. So that means you will include the amount that you're supposed to receive, but you have not received them, which will also be included for the calculation of the percentage. So you can see from 2016 to 2019, the amount is 5, 8, 6, and 5. So it all comes to 24 million, right? So how many percent of completion that you would achieve in 2016? So it's basically 5 out of 24. That's the percentage. Okay, so if you say 5 out of 24, and if the whole entire project you're estimating a profit of 8 million, so what is the estimated profit for this particular project in 2016? You can see that they've given you these calculations over here. So it's 5 out of 24 times 8, then is basically 1667. Okay, now do understand that what is happening is we started with estimated figures. Okay, we started with estimated figures. Now I'm sure you get the logic that the government will not just tax you based on an estimated figure. What happened is at the end of the project, you will only know the actual results, right? And that will actually be in 2019. So what happened is in 2016 to 2018, you will use an estimated result so that you will derive what is the estimated profit for the respective year of assessment. But comes to 2019, when you have actually derived the actual figure, you will then take the actual profit minus of all the prior YA recognized profits. So that means if, let's say for example, at the end of 2019, your actual profit was not 8 million, but it was 7.7 million. So what you're going to do is you will minus out the 1.667, the 2.667, and then the 2 million. Now, how do I get this 1.66, 2.66, and the 2 million? How do I get all these figure? Is based on the percentage of completions derived from the progress payment method. So that's basically an approach of how we recognize the income for a property development company, or it's actually the same even for a contractor. So you can see that there's also a public ruling for construction contract that the basis and the principles are similar for a property development company. Now, this is the first things that we see here about recognizing the income. So the whole idea is you can be a property development company and you can actually have various projects going on at the same time. So let's say there's a property development company, all right? That's a property development company. And what happened is you're having various projects going on at the same time. So you have project A, you can have project B, you have project C, and so on. Now, every single project has to be recognized as a separate and distinct source. That means project A, you have to recognize it on itself. Project B is recognized on itself, although that they will all be consolidated together as a source, but they will all be recognized as an individual separate source. Then they will be consolidated under the same business. Okay, now because you have various project sources, right, eventually the question is, can I use different method for different project to determine the percentage of completion? The answer is yes. So you want to use the progress payment method in project A, you want to use the cost method in project B, fine, you can do that, okay? But the whole idea is you got to be consistent. That means you have to, example, when you have started a progress payment method for project A, you have to use progress payment method all the way until the completion of the project. You cannot say 2019 I'm going to use progress payment, then 2020 I'm going to start to change back to cost method. But that's what the Inland Revenue will not allow you to do. So we know that the computation is based on an estimated figure. So there is a very legit questions that we like to ask. What if when I first estimated the income or a profit, the figure was much higher than what I think is going to be, so that I would like to do a variation to my estimate? Is that possible? So we're looking at variation to the estimate. So can I start with, let's say, an estimated income of 5 million, and then later on I thought that no, I don't think I'm going to get 5 million, I think I'm going to get 4 million. Now, are we allowed to do that? And the answer is yes. So I will bring you to the public ruling to look at this part. So this will actually be in point 8. The revision of estimates and tax computation. Now you can see over here that they say in the course of a project there may be situation that the original estimate has to be revised. Now they give you example of the circumstances of why a revision will be carried out. Like there is a variation in the development cost that you have estimated, there's a variation in the selling price of your property, or there could be any other commercial reasons that the Director General finds that is acceptable. So you are allowed to do a revision of that estimate. So the issues that we need to consider now is, if let's say I do a variation to that income or the profit of the project, how would that affect the way that I will compute the income for tax purpose? So again, I'm just going to show you an example that was actually given here by the Inland Revenue in the public ruling in example number 13. Now let's just jump straight to the figure. Now originally this was the so-called profit that you have estimated is 3 million. So the 3 million is derived based on 10 minus 7, and then these are the amount that you believe you're going to get. Now it's a very easy figure because your sales value of the project is 10 million. So if you think you're going to get 3 million, that's like 30%, 30%, 30%, 30%. So if you have stick to that estimate, you would have recognized a 30% of 3 million, which is 900,000. 600. That means you would have recognized a profit according to this figure here. 900, 600, and 600. Okay, but in 2000 and it says over here in 2018 they think there is a need to do a revision because the development cost of the project has gone up, and also the selling price has gone down. So these are two valid reasons for them to do a variation. So now the new estimate is they only get 9.5 million of sales and 7.5 million of cost. So the sales value has gone down, the development cost has gone up. So as a result of that variation to the estimates, now you notice the profit is only left with 2 million. So if the profit is 2 million, now because you have adjusted down your selling price, you will obviously adjust the amount receivable, because the amount that you collect from your customers is obviously lower, right, as a result of the adjustment of the sales value. So that's why you can see now the amount receivable become 3 million, 2.7, 1.9, 1.9. So it has all been adjusted. So if you use 3 million and follow with this figure, so that means if you've taken 3 million out of 9.5, which is the new value of the project, and you multiply by 2 million, you will actually get a revised estimated profit of 631,580. And then if you take the second year figure, you will get 568 and then 400 and 400. So now you will have a 2 million revised estimated profit for this project. Now, but the issue is this revision only take place in 2018. So your 2017 so-called tax would have been done and closed. The case would have been submitted. So as a result, what do? Do we go back and reopen the case and tell the Inland Revenue, hey, I want to bring down the 900,000 to 631? The answer is no. We don't do that. So that's why they say the property developer will be assessed at 900,000 using the original estimates. That's the original 900. And then the 2018, 19 and 20 figure will follow the revised figure, which is 568, you see that? And 400. Now, but for 2020, that's where your project is going to complete. So when you're at the completion stage of the project, you don't really need to use estimate. You will be using the actual results. So when you have the actual results, then you will be able to decide how much will the actual profit be. So if, let's say, if I follow this example, they say at the end of the day, the actual profit is at 2 million. And because you have already recognized originally a 900,000 profits in 2017, and then you recognize another 568.42, and then you recognize another 400,000 in 2019. Now that will only leave you with, how much is the profit? Yeah, it's actually given here, 131. So the profit will not be 400,000, but it will actually be 131.58. Okay, so this is a very short and quick sharing that we have done using the public ruling that is concerning with property development. I hope that this video has helped some of you that is involved in this industry, especially those that you are just recently employed in this role. Okay, so if you're interested with any courses that's run by Genesis, Origo, or our training, please feel free and welcome to reach us. Thank you very much. We'll have more sharing in the future. Bye bye.